A very good evening, everyone, and thank you for joining us physically this time at our second quarter results press conference. My name is Rishi, and on behalf of Infosys, I'd like to welcome all of you, our friends from media, our leaders from Infosys. We are delighted to host you today. A couple of house rules before we start. We have a lot of friends from media present today, so I will request one question from each media house, like I always do, and so that we can accommodate everyone over the next 1 hour. With that, let me invite our Chief Executive Officer, Mr. Salil Parekh, for his opening remarks. Over to you, Salil.
Thanks, Rishi. Good afternoon and welcome. It's always good to have all of you here on the campus, and I'm sure you're also enjoying being back in person and being at our campus. So thank you for being here. Our Q2 performance was strong with year-on-year growth at 18.8% and sequential at 4% in constant currency. Growth in Q2 was broad-based with all industries and geographies growing in double digits in constant currency. This momentum is accompanied by a strong pipeline of large deals and the highest large deal value in the last 7 quarters at $2.7 billion. 54% of this is net new. These elements are a clear reflection of the deeply differentiated digital and cloud capabilities we have developed that are highly relevant for our clients' strategic priorities. Our digital revenues are now 61.8% of our overall revenue, and they grew at 31.2% in the quarter in constant currency terms. While digital continues to see strong growth rates, we are seeing this quarter acceleration in the growth trajectory of our core services. This is due to our industry-leading automation capabilities and reflects an interest among clients towards cost optimization programs. We also see this in a large deal pipeline with strong focus on cost reduction programs in addition to the digital transformation programs in the pipeline. While we generally do not share the specific amount of our cloud revenue, we are delighted to share that in Q2, our cloud revenue was larger than $1 billion, showing tremendous strength of our cloud services, especially our industry-leading Cobalt capability. A strong growth was accompanied by operating margin expansion of 150 basis points, where we had an operating margin in the quarter of 21.5%. This stemmed from cost efficiencies, optimization in large deals, and currency benefits. Our attrition has been decreasing now for 3 quarters on a quarterly annualized basis, including now in Q2, and we see this trend along a downward trajectory. In keeping with our capital allocation policy, the board has announced a share buyback of rupees 9,300 crores and an interim dividend of approximately rupees 6,940 crores. With that, let me open it up for questions. Rishi, over to you.
Thank you, Salil. Joining Salil is Mr. Nilanjan Roy, Chief Financial Officer, Infosys. With that, we'll open up for questions. The first question is from Ritu Singh from CNBC TV 18.
Hi, Salil, here. A quick question on your guidance that you've given from 15 to 16% for revenue. You've tightened it further to about 14 to 16%. The upper end remains the same, but if you could give us a sense on what made you tighten the guidance, and also on your share buyback. You had the option to go all the way up to 18,000, as we understand. Why capped at about 9,000 odd that you've done? Thank you.
So on the guidance, we've had an incredible large deals performance in this quarter, 2.7 billion. We've had strong momentum, 18.8% growth in the quarter. We continue to see good traction. We also see that there is some caution. Last time we had mentioned that we saw some caution in mortgages in financial services. We talked about retail. We now see some caution in high tech and in telecom. Keeping all of those factors, the positive factors and the global macro factors, we have decided to make our guidance narrower at the higher end of the band that we had. So it was 14 to 16, and now it's 15 to 16. On the share buyback, let me request Nilanjan to address that, please.
Yeah, so on the share buyback, of course, the board considers a lot of factors, but coming to your specific point on the maximum, since it's an open market offer, it's limited to 15% of the share capital and reserves, which is about 9,400 odd crores, give or take. So the board has decided a figure of 9,300.
Thank you. The next question is from Anisha Jain from ET Now, and Anisha sent her question on text. What has supported the margin performance? What are the levers to improve margins hereon? Deal win is strong at 2.7 billion. Going forward, do you expect clients to cut spends of this run rate of over 2 billion? Will that continue? Will FY24 also see double-digit growth?
So let me start with a couple of them. The margin, Nilanjan will come back on. On the deal wins, I think this is an incredible performance from the company. 2.7 billion is a very large number. We have a very strong focus on large deals, and 54% being net new, that gives us a really good platform for what we see in the future. Now, large deals, we've always maintained, these are volatile. Some quarters, the numbers are high, some are low. These are not a very predictable outcome, but in general, if you look over a 4-quarter period, we have a fairly good large deal momentum. Our pipeline for large deals remains quite strong today, and it's in a good position. So we feel comfortable with where we are in the market. Just to add the macro comments that I made in the earlier question, those obviously still hold.
Yeah, so on the margin, we've improved from 20.0 to 21.5 sequentially, which is 150 basis points improvement. We got 70 basis points out of that because of the currency benefits. All currencies versus the dollar, as you know, depreciated as well. And of course, there was a cross-currency impact. So that gave us 70 bips. We got 90 basis points from cost optimizations. And of course, you're aware of the levers we deploy in terms of the pyramid, in terms of automation, in terms of on-site offshore pricing. So between that, large deal optimizations and other costs which we have been able to take out, are partly offset by utilization. We got about 90 bips from there. We got about 40 bips from reducing our subcons, again, a cost lever which we've been trying to attack. That gave us 40 bips. And this was offset by about 40 bips from comp related because some of our comp hikes were rolled out in 1st July, as we mentioned. So all in all, we got 150 basis points improvement. If you see from the guidance perspective, and as we had mentioned in the last earnings call, we had said we will be at the bottom end of our 21-23 guidance. We have now looking at our first half performance. We have for this year at least tightened it to 21 to 22%, and we expect to be at the bottom end of that band.
Thank you. The next question also on text is from BQ Prime. Sajith Mangat asks, for Salil, can you elaborate on the demand environment in the US and Europe in context of the geopolitical events in Europe and macroeconomic challenges seen in the US? What is the exposure to Europe, especially Germany? And how do you see the TCV pipeline? And for Nilanjan, similar question on margins again. How do you see the trajectory for margins given weak traditional H2? And what is the kind of leverage available with respect to bench utilization?
So on the demand environment, what we see is on the macro front, what I shared earlier, which is we had indicated last time we started to see some concerns in the mortgage side, in financial services, in the retail industry. We are seeing this time some concerns on high tech and in telecom industry in addition to those. These are more on the discretionary part of our pipeline. We also, at the same time, seeing a strong large deals pipeline, which gives us some confidence. We've pivoted, and I think the market itself is also pivoting with the clients, where there's more and more interest in automation and cost efficiency, and we see that coming through within our pipeline. We've seen growth both in digital, over 30%, and in core, which shows that both of our engines are working quite well. In terms of US and Europe, today, in Q2, we had a very strong growth in Europe, over 30%, strong growth in the US, over 15%. We continue to see the pipeline between both of those geographies today, but also keeping in mind that we are being watchful given the macro environment developing.
So on the margins, as we look at second half, we've ended the first half with about 20.7%. And like we've guided at the bottom end of the 21 to 22%. So of course, margins for the second half will have to go up. And of course, we have our levers in terms of our utilization, which is one of the factors mentioned, because we are really at the bottom end, of our utilization. As we put a lot of freshers into the system now, they are sitting on the bench, but over a period of time, they will start getting deployed. So this will become a tailwind. As attrition starts coming down, of course, this will be a benefit in terms of stretch salaries. So that's one of the other things which started helping us. So I think we've, in this range of 21 to 22, we are quite comfortable for the full year as well.
Thank you. The next question is from Z Business, from Kushal Gupta. Kushal, question for Salil. Europe's growth has been great with 28.5 constant currency growth. Is there actually no issue with client IT budgets for the next year amid the fears of recession? And for Nilanjan, operationally, the performance has been great. What were the key factors behind this and the outlook ahead?
On Europe, I think we've had a very good traction in Europe for the last several quarters, and that is shown again in this quarter's growth number. We continue to see the pipeline of large deals is strong, but we are also cautious and watching the macro development. But today, our pipeline looks good, and our guidance for the full year, therefore, is at 15 to 16%. On the operational.
Yeah, the operational, of course, as we have mentioned, of course, we have a good margin story, but I think even beyond that, our ability to absorb freshers in, making sure that they are trained, they are picking up new skills, putting them into projects, and then over a period of time, start rotating them. So because this talent pipeline, for us, we knew in the long run was the only way this industry would grow, right, other than rotational churn. And therefore, in fact, in the first half, we've already done, I think, close to 40,000 of the freshers across the company in all streams. So we are quite hopeful in terms of absorbing the freshers, putting them, through their paces, and then start putting them into large deals and other deals as well. So that's been a big learning for us during this entire process.
Thank you. The next question is from Chandra from Moneycontrol.
I just want to ask you about, the net employee addition number. I mean, it's usually a good lead indicator of growth. And that has come in at 10,000, I think, which is what compared to 21,000 in the previous quarter. So what does it say about, the growth going ahead? I mean, because on the one hand, you sound confident, but is this also a sign of caution? What are you hearing from clients and conversations? Because other companies are saying, at least in Europe, the discussion is only about how they're going to manage the winter. So if you can give us a sense of, what you're hearing from North America as well as Europe. Nilanjan, a question on the margin guidance. You've kind of tightened it at the upper end at a time when supply side challenges are coming down. Again, how should we read this? Are there growth constraints, pricing constraints? And if you can also tell us about why you're opting for a market buyback for the second time, because even the last time, many shareholders felt it was a negative move because it really doesn't benefit them. So why are you opting for a market buyback? And one question for the HR head on moonlighting. Infosys, sent out a missive to its employees on how they should not do time. But if you can give us your views on moonlighting. Thanks.
Thanks, Chandra. On the first question, I think 10,000 is a very strong net addition for us on top of the 20,000 that we had in the last quarter. Having said that, what we see with clients in the industries that I was referring to before, for example, mortgages and financial services or retail or parts of high tech or telecom, we see more caution in the way that the buyers, the clients are looking at services. We also see some impact on discretionary spend there. At the same time, our pipeline is extremely large. We had a very strong large deals number for this quarter. The way we are looking at it is we are making sure that we support our clients as they're looking for their growth transformation programs, and now more and more for their cost efficiency, where we're deploying our automation services, those programs. And our pipeline has shown that there are more and more of those types of activities as well. Our view is we are ready in this macro environment for all types of client work, whether it focuses on digital and growth, whether it focuses on cost. And yet we want to be careful that we are cognizant of what's going on with the macro environment and make sure that we go into this watchfully. So that's how we are seeing this progression happen at this stage.
What?
Sorry? I'll repeat the full answer. But I'll repeat the whole thing. You take whatever meaning that has.
So on the buyback, I think firstly we have a very predictable capital allocation policy, which we believe is really best in class. It is a 5-year policy. From FY20 to FY24, we said we will return back 85% of our free cash flows. So it's a very predictable policy. It's got a dividend element on it, and it's got a buyback and an option also to do special dividends. And therefore, we also look at over this period, how will our cash flows change, and therefore, how do we give back money in terms of both dividends and buybacks or through a special dividend. And therefore, we also want to see how much cash we have on the balance sheet. So it's not about finishing our cash day one. So we pace all this out. And of course, one of the ways you can do it through a tender offer or through an open market offer. And we've seen our past, in fact, our last 2 were open market, not the last one. Last 2, we've done open market offers. And the board feels, looking at our listings in the US, our regulatory concerns, EPS accretion, that it could be better to go for an open market offer. So they look at other considerations as well. And they decide to go for an open market. On the margin guidance, of course, I just mentioned, see, we are at 20.7, right, at H1. And like we said, we are going to be at 21 to 22 at the bottom end of 21. So, mathematically, we will have to be probably closer to 21.4 or something to even hit 21. So we're looking at margin levers going ahead. Of course, as we've talked about, there will be some abatement from the attrition side. Of course, they'll be on the same side headwinds because of furlough, because it is a seasonally weak quarter, as you mentioned. So we will have some headwinds coming from furloughs, lower working days. And which of some of these we will try to offset through our cost optimizations, etc. And therefore, like we said, the 21 to 22 is a narrow band which we'll be comfortable with for this year.
On that, let me address it the way. One of the things that our companies always focused on is making sure that we have real attention to learning opportunities and generally opportunities for all of our employees. And we've always encouraged our employees to have that sort of a mindset within the company. In fact, within the company, we've set up over the last several years, so not now, not last week, over the last several years, a platform which we call Accelerate, through which employees can look at what we call internally gig work, different projects outside of their main work. On an average quarter, over 4,000 people apply for this. About 600 are selected. So it's something that is active within the company. Now, for gig opportunities in the external environment, we support the aspirations of our employees to learn beyond their work. We will support them to work on certain gig projects after the prior approval of the managers. We are also developing more comprehensive policies for that, while ensuring contractual and confidentiality commitments are fully respected. However, to be clear, we do not support dual employment.
Thank you, Chandra. Chandra, we'll come back to you, Chandra. We'll come back to you, Chandra, please.
Salil, has anyone been fired from Infosys for moonlighting, and what kind of processes do you have in place to catch moonlighting? Like, can you technically catch people?
I don't have the information on the processes. If we have found in the past, if the employees who are doing blatant work in 2 specific companies where there's confidentiality issues, we have let go of them.
In the last quarter?
In the last 12 months, but I don't have the data. I don't have the data, but we can certainly get it to you.
Thanks, Chandra. The next question is from Shilpa Fadnis from the Times of India.
Hello, sir. Infosys believes in converting an adversity into an opportunity. What are the two or three things that you would do differently in a probability of uncertain events, especially when the client's decision-making velocity has slowed down? My second question is on barring BPM, very few subsidiaries are firing up. You and Mr. Roy did an internal review 2 months back on different subsidiaries. So are you taking a hard look at some of them and are you folding some of them?
Sorry, Shiva, can you just repeat the first one, please?
Infosys believes in converting an adversity into an opportunity. What are the two or three things that you do differently when uncertain events are panning out, especially in terms of macroeconomic indicators and the client decision-making velocity slowing down? And my third question is, Infosys long back, started collapsing layers internally. Recently, we've seen some of the seniors are put on sabbatical. Some of them are let go of due to account-related challenges. How do you plan to motivate this pack, especially when, we hear that variable payouts, JL7 and above, have still not been rolled out?
Okay, I'll start with the first one. I think it was a question about how do we convert in this environment a different situation to what Infosys can do best. I think that's a very critical sort of point. What we are seeing in this environment is the capabilities that Infosys has. We have a very strong set of capabilities on digital and cloud, and we're seeing good traction and growth on those. We also have very good capabilities on automation, leveraging artificial intelligence and machine learning in efficiency. And we are seeing a very good traction on the cost programs where clients are looking at efficiency. So what our approach is, we want to make sure that both of those pillars, both of those engines are available to clients, depending on what situation they are in. And as the macro develops, because the macro will change, there could be positive stimulants, there could be negative stimulants. So that are things we don't know. But we have both of these engines which are working well, and we believe that that will support us as we look at it in a careful way as we go through the next period of time. Now, the second one was about subsidiaries. Do you want to take that one?
Yeah, I mean, we review subsidiaries every quarter. It's not as if it's an annual exercise. In fact, three of our best subsidiaries, Ben is here, Andrew is here, Radha is here. So, we continue to push them for performance. There's no question about it, the way we get pushed. So that's part of the game. But I think we all are doing them very well. They've a lot of synergy benefits. Ben across the entire DX world. Wong Doody is now across Europe, in India. It's now in the US and across the DS. And it's a very large platform for us to take to our clients on the experience. So I think we have no concerns really.
And on the layer, I'm not aware of people on sabbaticals. We have, I think, people who are, we have internal tracking, for example, connecting with our employees, and we track what we call our engagement scores. And we've seen a steady and good increase with our engagement scores across our company. We are seeing a real connect where people are seeing, there's a new set of policies and initiatives that our HR team have rolled out for leadership development, for skilling, for making sure that there is much more awareness and support in the time during COVID, both from a medical perspective, but also from a mental health perspective. So we are seeing a lot of traction. I don't see any of those levers being something which is a concern. There's always something that's being watched at. And in fact, we are now seeing last 3 quarters attrition coming down quite significantly each quarter. In Q2, it was down by over another 2 points in the previous quarter. So we think some of the initiatives that were put in place are starting to have an impact, and we will continue to drive those initiatives ahead.
Thank you. The next question is from Sai Ishwar from the Economic Times.
Hello, sir. Sir, you had said that you're seeing caution in mortgages, financial services, retail, and that's catching on to high tech and telecom as well, right? So, can you actually tell us whether these are discretionary spends that are getting affected, or do you see the total tech spends itself being held back by clients? And also, one more question to Nilanjan sir is. We are also hearing news about the onboarding delay of freshers, right? So, but on the other hand, you've already reached 40,000 target in terms of fresher hiring. So, how should we read into this? Because we are hearing reports saying people who got offers in 2021 are not onboarded yet. So, did Infosys probably overestimate demand? Yeah.
So on the first one, I think the what we're seeing in those specific industries that I mentioned, whether it's mortgages or high tech or the others, is an impact on the discretionary spend right now. What we're also seeing is, just stepping back from all of that, that many large companies are also looking at being more cost efficient. So we see that given that we have a strength in digital, we have a strength in transformation, we have a strength in discretionary, and we have a strength in automation and cost efficiency, that we are able to support clients on both of those engines. But we do see those areas where we see some caution in more of the discretionary side.
On the fresher side, I think, like I said, we've already done 40,000 and we told you, in 50,000. So I don't think there's been any delay, particularly that, we have continued to put in Mysore. A lot of people are going to Mysore. In fact, in physical, it's a good thing. We've opened up the campus, and it's a big attraction for our talent to go through the physical training of Mysore and then go to the DCs. So we are quite tracking as per our plan. In fact, like you said, our 10,000 net add probably is the highest in the industry. Even upgrade the 50,000 number for the year? I mean, it will go up. We haven't given out a number as yet, but of course the 50 will go up. Yeah.
Thank you. The next question is from the Hindu Business Line, Haripriya Sureban.
Hi, sir. So what percentage of your workforce is back to the offices? What's your play there? Do you intend to call your employees back to offices? And second question on attrition, you're sort of tried to gotten it down. So what's helping you? How have you achieved it? And do you see more moderation going forward? Thank you.
On the return to work, I was looking, we're looking at this every week. Last week, across India, we had about 45,000 employees in the office at any given time, not all the 5 days, but at different times. And that's a huge number given where we were, where everyone was in this industry a few months ago. What we are finding is the approach we've taken so far, which is essentially, we've been extremely supportive of our employees. We've been extremely supportive of a flexible approach, has been well received, and it's working. We're seeing that this is now gradually increasing. A couple of weeks ago, I was in the Pune DC. In fact, Radha and I were both there. We could see a lot of engagement with employees as we connected with several of them. My sense is, over time, we will make all the support necessary so more and more employees can come back. There are, of course, several client situations which require specific action. So those will be followed as the clients are requiring it. But where we are able to provide some flexibility, we will continue to provide flexibility. On the attrition, there were several initiatives that Krish and our HR team rolled out maybe now 12, 18 months ago. And I think we'd shared with some of those. There's one of them, for example, where there's a very well-defined path in terms of career in the first several years of an employee, and the steps are clearly defined and well understood. That's a big positive for employees, because there are no surprises then anymore for them. There's a lot of emphasis on leadership development and skilling. There are programs with large global universities which the company runs, which give employees the ability to self-improve. And then we have our online platform, which allows employees to do it. So there are several of those initiatives, and as a combination of that, it's worked. The trend, last 3 quarters is good. And my sense is these initiatives will continue to give us benefit.
Thank you. The next question is from Reuters News, Sethu Raman.
Good evening, sir. So just wanted to know, was there any standout deal closure this quarter? Would you be able to help me with your benchmark for the large deal? Just wanted to know, whether there were multiple the size chunk of deals, or and also want to know about the smaller, were there any smaller deals, because you don't normally give out details on the smaller ones. Last minute buyback announcement and the open market buying was looks like a bit of pressure from the market in terms of I just want to know, was there any pressure in terms of, because normally you consider buyback when you come out with the earnings announcement. So this was a last moment. So there was there any delay, any consideration about that? And so last one was is there any reorganization going in the company with Mr. Ravi Kumar's exit? Will the backfill happen for the president's role? Are you looking at anything? Thank you.
I'll start with the first one. I think on large deals, we had 27 large deals. So for us, large deals are deals which are more than 50 million in value. And so it's a very significant size of a deal. We don't give out any specific deal information. To give you a sense, there are 27. That number can give you a sense given the overall value of the large deals. On the buybacks, let me start, and Nilanjan might want to add. We had a very well-defined capital allocation policy. We've followed all of the reviews internally and externally on that. We feel no unusual activity, whatever sort of phrase you use. It was a well-informed decision by the board. And we think it's going to be a huge positive, because we have a capital return approach through this policy. And Nilanjan can add a little bit on that in a second. On Ravi, first, Ravi is a good friend. I wish him all the best in his new endeavors. Infosys has incredible leadership talent in my mind. So over time, we will make sure that all of the activities are in the best interest of the clients, the employees, and the company. Anything on capital allocation?
No, I think, like I said earlier, our capital allocation is very predictable. We said 85%. In fact, last year we had given 73%. So I think if you have to catch up to 85, buyback was the most natural way to do it. So I don't think there's any pressure or anything. And that's the beauty of our policy. It's so predictable.
Thank you. The next question is from Binu Paul from Business Today.
Yeah, on the hiring of the freshers, so there's a large number of people that you've hired, you've planned, and I just wanted to ask, what's the kind of impact when these freshers, get onto newer projects it'll have on your cost optimization and margins?
On the hiring of college graduates, I think last year we had done something in the range of 80,000 college graduates who joined us. One of the things that we are extremely good at and known for is our training program. And especially now that everyone is back in person, our Mysore training capability, in addition to what we have now, which is online, we've also set up training for some of the modules within our different DCs, our delivery centers. So we find that these individuals coming out of that Infosys training are extremely ready to start to be productive, and they help us tremendously. Last year, we had 20% growth. Q1 was 22%. this quarter 18%. So that needs a tremendous input that we see of new employees joining us.
Thank you. The next few questions are on text. We have a question from Shivani Shinde from the Business Standard. Attrition is still in the 20% range. By when do you see this coming down to sub 20%?
On attrition, my sense is it's come down 3 quarters in a row for us. Each quarter a sizable, large step. All of the initiatives that have been put in place by the company, by the HR leadership, are starting to yield some benefits. Over time, my sense is we will continue to see more benefits with attrition.
Thank you. The next question is from the New Indian Express. Any plans to make work from office mandatory as your peers are calling employees back to office, or any plans to continue the present work from home model? Also, are there any plans to increase local hiring in the American and European markets?
So on that, I think what we've seen is over the last several quarters, all through COVID, our work from home approach has been extremely effective for our clients and for our employees. We've now seen already a lot of our employees coming back. We've put in place in the past very flexible approach where employees really had a tremendous amount of choice. And we see this traction week on week on its own increasing of employees coming back. We want to make sure that we build things in the future which keep this element of flexibility and make sure that if there are some client-specific needs, we address them. But we want to make sure that it's something that our employees are comfortable with.
Thank you. The next question is from the Financial Express. What is the revenue model for Infosys from 5G? Are you in talks with clients to leverage the opportunity? There's also another question on moonlighting, which we've already answered.
On 5G, it's really a step change in the world as it is in India. Infosys, we've developed huge sets of capabilities for 5G client solutions, first for the telco industry, and also for use cases which are for other industries which are leveraging 5G. For example, retail or financial services, logistics, warehousing. There's a host of these that we've developed. We see a huge amount of traction in this business as we look forward. And so it's one of the growth drivers that we will continue to see in the future.
Thank you. The next question is from CNBC Awaz. Are you sensing any hesitation from clients on expanding budgets? What is the sentiment of clients in Europe? You mentioned some pressure in BFSI. Is it likely to worsen?
On the client environment, we see the macro, all of us, the information that we read, but it sort of comes down to us in different formats. One, we have really 2 big drivers or engines on digital, which is growing in Q2 for us, and core services, which is also growing, both supported by very strong capabilities, whether it's Cobalt or automation. We also see that there are, in the macro environment, specific areas where we are more cautious, mortgages in financial services or retail or high tech, some parts of high tech or telecom. But at the same time, our large deals pipeline is doing quite well, and we see a good traction in this quarter in large deals, which was at 2.7 billion. So all of those are sort of different aspects of what we see in the environment.
Thank you. The next question is from Deccan Herald. How is the overall pricing environment? Are you looking at passing some of the costs to clients where cross-currency movement has an adverse impact? Will the current pricing power sustain in the second half of FY23?
Yeah, so I think inflation across the world really is quite pandemic in a sense, or a way we're seeing it across geographies. It's both across consumer prices, wage inflation. And of course, we are going back to many of our clients. One is as part of the clauses which we have, like COLA. Sometimes we are going back as part of our digital pricing and trying to demonstrate the value we'll be able to bring, for instance, in the cost takeout program, and part of that, how that can be taken back in terms of pricing or productivity with us. So these are multiple conversations across each client, because each clients are unique. The FP contracts, T&M contracts, mid-cycle contracts, new contracts. But the good news is that we have seen firstly a reduction in discounts that's very visible, that the kind of earlier discounts we would have on renewals, etc., have definitely come down. On the other hand, we are trying to position ourselves on more increasing our prices on digital rate cards, at the same time demonstrating the value this talent can give. So the answer is yes, but this is a very long haul. It will take time. It's not something which we can flip the book every quarter, but this is something which we are seeing some traction.
Thank you. The next question is from the Informist. How do you see the Q3 performance given the macroeconomy situation? You've answered this, in case you want to add any more color to this.
Just a bit, I think on Q3, I go back to, we don't give a quarterly guidance, we give annual guidance, and there we've taken our growth guidance, which has gone from 14 to 16 to 15 to 16, which is at the higher end of the growth guidance. Expect, sorry? Top it where?
You expect to top your guidance to lower end, 15 to 16.
We expect it to be in the 15 to 16, yeah.
Thanks, Chandra. The last question for this evening is from the Mint. On the India market, given that there has been steady growth of enterprise spends for digital transformation in India, how does Infosys expect the domestic market to contribute to coming quarters?
So on that, we have extremely bullish on where the Indian digital transformation agenda is. We've done projects which are really mission critical. We can see, for example, on the GST program, there's a tremendous realization and increase in collection that the government is seeing through digital implementation of a completely new platform. We've seen this year similar things with the IT platform. So we are well positioned to do scale digital transformation programs, and we look forward to working with government organizations, private companies in that area as appropriate.
Thank you. With that, we come to an end of this Q&A session. We thank our friends from media for being part of this press conference. Thank you, our leaders from Infosys, for being part of this press conference. Thank you, Salil. Thank you, Nilanjan.
Thanks.
Before we conclude, please note that the archived webcast of this press conference will be available on the Infosys website and on our YouTube channel later today. Thank you. And
Hi guys, that was the management of Infosys talking about the fine print of their performance for the quarter gone by. Let me quickly read out the headline numbers once again to refresh the memory. Revenues in constant currency terms grew by 18%, 18.8% actually year on year, 4% quarter on quarter. Reported revenues came in at 36,538 crores, which indicates a growth of 23.4% again on a year on year basis. You had operating margins coming in at a solid 21.5%, better than expected. In fact, on a sequential basis, it's a growth of 1.4%. Let's slice and dice the numbers with the two guests joining us right now. One of them is my colleague N. Mahalakshmi from Moneycontrol, and the other is Mayuresh Joshi from William O'Donnell. Guys, thank you so much for taking time out and chatting with us today. Mayuresh, I'll start with you. You track the IT space and Infosys very, very closely. What has been your verdict for the report card for Q2? Mixed bag or better than expected?
Good evening, Karunya. Good evening, Mahalakshmi. So largely, I think the numbers have been a mixed bag or in line with estimates, however you want to put it. I think if you probably look at the constant currency and the dollar revenue growth, a tad bit below expectations, but I think the beat that has come on the operating front, EBIT margins expected around 20.5 odd percent. They've clearly come at 21.5, so that's a clear beat in terms of how the operating performance for Infosys has been. Hearing the management out as well, and a large part of their expectations in terms of attrition actually flattening out what we'd seen a couple of quarters back and has started to come down. I think that is one positive sign that the management probably feels, and the industry and the analysts who probably track that. In terms of the guidance going forward, revenue growth in constant currency terms has been raised. So that's a positive sign in terms of the gloomy environment that we are talking about at this point of time. And the EBIT margin band probably more or less in line with estimations as well. So the pressure points that can probably come through in terms of pricing, in terms of subcontracting costs, and in terms of further automation, I think the management is being a little bit cautious on that. So I think more or less numbers in line, Karunya, as I see.
Okay. Mahalakshmi, will the street be more happy about the beat on the operating front, or will they be rather upset about the revision, the downward revision, the mild revision that they've done in their EBIT margin guidance? Which way is the street going to lean in tomorrow?
I think one way or the other, I don't think the market is going to be too excited or too perturbed about the results because they're largely in line with expectations. So, and today the environment, this is what I said even after the TCS call when we had a similar interaction, that this is not an environment where you can really cheer the market, because the market is not really looking at what happened or what transpired in the past quarter, but some hint about what is to come. And even what is to come is right now not evident, because like even in the TCS con call, they said that conversations about how pricing environment or how the economic environment is going to shape those conversations will start only 3 months to 6 months down the line. So you still don't have any hint about how FY24 is going to pan out. And that is what the market is really worried about. So I don't think, and in any case, there is no negative news in these numbers. You can't fault the company numbers on any count at all. And this margin revision also, Karunya, it's really not much, because at the lower end, you had 21% earlier, you have 21% now. So there is nothing really to worry about. And they had actually breached that 21% and gone on to 20%. So the fact that they have come back into the range is something analysts should be cheerful about. So no bad news is not good news, but it can remain that way. We can digest this.
But what about the share buyback? Because as an initial reaction on our YouTube feed itself, I saw a lot of conversation happening that the fact that it's going to happen via open market. Why are people a little worried or unhappy, from what I could gauge in the comment section? Why are they not happy with the buyback announcement? Is it only because of the quantum, because it's lower than expected, or will open market buyback make any difference to a retail investor's life?
See, First of all, they have announced a 9,300 crore buyback, right? So we had various estimates around the buyback amount. So some of them even were expecting a 10,000 to 12,000 crore buyback announcement. So it's a tad lower than what some of the estimates were. But I don't think that should really matter, because the company's stated policy is very clear. They have said that they are going to distribute 85% of their free cash flows out to the shareholders, either through buyback or through dividend. So that money is going to come to the shareholders any which way. So of course, buyback is a more tax efficient way of giving it to you. Fair enough. But I mean, you don't have to really crib so much about, 1,000, 2,000 crore smaller quantum. Coming to this tender offer versus market offer, I think from the company's point of view, it really makes a lot of sense to go for market buyback in an environment like this. And why do I say this? Because when your share price is, so what is the objective and concept behind the buyback? The buyback essentially is done to ensure that you reward the existing shareholders who wish to stay put in the company. You are trying to enhance value for those shareholders, and you're offering an honorable exit to people who want an out. So now the expectation that you should do a tender buyback at a certain price comes from investors who want an out, who have probably burned their fingers, not made money in IT. So they're looking to the company and say, hey, do a buyback because I bought it at this price. I want an out at this price. So you should give me this price, But from people who are going to stay put in the company, if I'm a long-term shareholder, I want to stay put in Infosys and I have faith in this company, it works for me. Right? Because you have to be buying assets at a cheaper price to be able to reward shareholders who are going to continue with the company. So I think it really works. And let me tell you the other thing also. For example, Bajaj Auto did a buyback last quarter, right? They said 2,500 crore buyback, which was of course a very small quantum. And they finally ended up doing those purchases at, I think, 3,800 rupees or something. The stock price today is 3,600 rupees. So it never went to 4,600 rupees, although they said that 46 is the price that, that was the price till which they were willing to do. So when the management anticipate that the market is not going to, any which ways is going to remain sluggish, no matter what they do, the environment is such that it's not going to really lift sentiment, it makes a lot of sense to just go and buy the stocks for cheap. So of course, people want an exit will crib, but I think it's not a bad strategy if you are a long-term shareholder in Infosys.
Yeah. Okay. So not a bad news at all for long-term investors. Mayuresh, want to understand your sense on the deal wins and the commentary that the management was also giving in, because they're saying that they're seeing acceleration in the core services, but at the same time, they've talked about traction, but with caution. Deal wins this time around have been good. Cloud revenue has crossed $1 billion. In fact, large TCV deal wins have been $2.7 billion. So right now things are okay. But in terms of forward looking or future visibility, what is the sense you got from the commentary and from the trajectory that all of these IT giants have been talking about?
So if you probably, Karunya, stack up the deal wins for all the four large IT companies, obviously HCL Tech and Infosys have given and delivered a beat in terms of the deal wins that were expected and what they have actually turned out to be. If you probably look at the deal wins and the granularity within that for Infosys in particular, they've added $100 million client quarter on quarter, and they've added almost 8 clients in the 50 million category as well. So I think deal wins have been very, very healthy. And all of these giants are sitting on very, very healthy order books. So if you read between the lines, I think all commentaries were probably hinting out to a lot of Christmas holidays, furloughs. As Mahalakshmi pointed out, I think Q4 is when the client budgeting will actually start, both in North America as well as the European zone as well. And if there is some amount of slowdown, the proportion will be defined in the next few months. I think budgets might get cut, but not that significantly is what the feel is even now. So I think there will be some heavy execution on the existing order books, is my interpretation, in the next few months. And therefore, I think the kind of revenue projections the companies have put forth should continue, both in terms of dollar revenues as well as constant currency as well. So I think deal wins very, very good for Infosys and HCL Tech. It's a clear beat. Wipro obviously has been a laggard on most parameters over the last few quarters, and is more or less in line with expectations. So solely going on deal wins, I think it's a good number that Infosys is posted.
But okay, maybe there may not be a downward revision or any kind of cutting back on the guidance that the management has given for the fiscal. But from FY24 onwards, do you foresee any pain or any sort of any further caution trickling in?
There might be, because I think if you probably look at a lot of product and platform companies based out of the US itself, I think they have been very, very cautious. Even Accenture, to a certain extent, has been a little bit more cautious in terms of the statements of accounts on the results that they have posted. So I think this calendar year, you probably might sail through in terms of the book that you have got. But if there are budget cuts which start happening because of macro conditions in the developed world, I think FY24 order wins might start trickling down a little bit lesser compared to what FY23 were. And therefore, if you then start looking at the base effect, I think if you start comparing numbers in terms of how order books were positioned a year ago, it might be a little bit on the softer side. So yeah, I think the industries that they service, as Mahalakshmi was also pointing out, BFSI, retail, manufacturing, are all interlinked and dependent in terms of how end consumer demand will probably stack up. And if there are genuine macro concerns, and if there is a genuine slowdown that probably happens, you might feel the effect in terms of slower and lower orders coming through for the next financial year. So I think the markets are in a readjustment mode in terms of forward numbers. They're probably trying to put out FY25 numbers, adjusting for lower revenues in FY24.
So you don't see any phenomenal reaction coming by for the earnings, do you? Or given the downtrend we're seeing following the numbers for IT, will that continue? What is your sense?
So if you look at two aspects, Karuni, I think one in terms of revenue projections, which might get curtailed in FY24. I think the markets are probably bracing for that, and analysts and estimates are bracing for that. But that will come to know in Q1 of the next financial year, or Q4 in India in terms as well, when client budgeting actually takes place. The second element obviously is in terms of the margin hit that the companies will still have. And there are 4 counts to the margin hit as well. One, as Mahalakshmi pointed out, pricing. I think how effectively will they be able to pass on pricing in a very tough environment is circumspect at this point of time. Subcontracting cost is significantly higher for most players. For Infosys, it's close to the vicinity of 11%. So that also takes a hit on margins. You've obviously got wage increases and the need to automate more. So as a percentage of digital revenue, 61.8 is a good figure for Infosys. I think that figure needs to probably go higher to probably have margin levers in your place. So I think if you look at both these aspects combined together, I think the numbers might be a little bit softer. Analysts, in my opinion, will probably have a relook at the numbers as client budgeting happens in Q4 and the readjustment there. So I don't expect significant cuts coming through. A lot of managements in the US are also expecting significant cuts in terms of order wins, but the cuts will come if there is a hard landing that probably happen, and therefore the circumspect view in terms of forward numbers for IT companies.
Okay. Mahalakshmi, one quick question to you about the attrition number, which is, I think, largely on expected lines. But the net addition in terms of talent headcount, 10,000, what is your sense on that?
It's a very good number. I think Chandra asked about she asked a question on this, saying that this looks like an underwhelming number, but it is not. I mean, look at what are the numbers reported by other companies this quarter. TCS was at 9,000 odd. Wipro was 600. I mean, this is, first of all, this is not a time where, you know, companies, while they are saying that there is good deal momentum and business is strong and they don't see a slowdown and so on, you don't want to be caught on the wrong foot. So management positioning has to be to ensure that you are, you are in a straddle kind of approach where, you know, both ways you are going to be okay. If the economy doesn't go into a tailspin, you are able to capitalize on growth. If it does, go off a cliff, you are not caught on the wrong foot. So from that perspective, I think 10,000 is a phenomenal number. And I just want to make one more point to what Mayuresh said also, that I think this one of the my reading of why the TCS and Infi management seem confident is not because not really an indication that there are no recession fears. I think their confidence stems from the fact that they are supremely confident about their leadership positions, their scale, and their ability to snatch away market share from the rest of the crowd. Because today also, if you saw in the press conference, he was talking about cost optimization, how they're not only positioned for digital transformation and growth, but also equally competent to work with the clients if there were needs for cost optimization. So that is what I think gives them the confidence. And even in last quarter, Karunya, Infosys did say that bulk of their industry leading growth is really driven by market share gains. So we can't read this as no indication of a US recession. We have to read this as their competitive position in the market being strong.
Yeah, well said. And on that note, I want to conclude this conversation with both of you guys. Thank you so much for pitching in and for sharing your analysis and your understanding of the numbers, fine print, and the commentary of the management from Infosys. Thank you so much, guys, for tuning in as well.
Thank you so much.
Thank you so much, Karunya. Thanks, Mayuresh.
Thanks, Mahalakshmi. Thanks, Karunya.